Afternoon, students. In the first session, we covered the income statement and balance sheet. Now we'll be looking at the statement of cash flow. It's actually quite interesting to start at the income statement and balance sheet and then work back to the cash flow statement, as a lot of students are very familiar with cash, where cash comes in, cash goes out. So in the first two sessions in the income statement and balance sheet, we said, listen, do not look at when the cash is received or when the cash is actually paid out. What you need to focus on in the income statement and the balance sheet is what we termed the accrual basis of accounting. What that meant was that you needed to focus on whether expenses were used up during that period, whether the risks and rewards had transferred of revenue during that period, and not when cash was received or paid. So we're trying to actually take you away from the cash, and now we're bringing you back to the cash transactions to look at when cash has moved in and out. The importance of the statement of cash flow is because your income statement and your balance sheet are looking at what has actually gone on during that period. You don't want an instance where you've actually received a lot of revenue, but it hasn't flowed through as cash in your business. It's a concerning sign when you've got all these accounts receivables and these people are actually not paying you over time. Or an instance where you've got loads and loads of debt that you've actually put in your business. And yes, you're managing to make revenue, but whether that debt is sustainable is the question. So what the cash flow goes and highlights is what is happening within the operations of the business in terms of cash, what's happening in terms of the investing activities in terms of cash. Are we still investing in our business, or are we using some of our long-term assets and selling those off, some of our PPE, our property, just to pay off some debt? So you can actually use the cash flow statement to see some of the signals whether the business is actually doing well or not in terms of its liquidity by looking at a cash flow statement. The important thing with the cash flow statement, the second thing, is you need to make use of your income statement and your balance sheet. So we already had prepared those using the accrual basis of accounting. Now what you are trying to do is reverse out all those accruals that you had created, the accruals being those items that actually didn't relate to cash and actually only reflect the cash inflows and outflows that happened within this business. Why is it important to assess that? I said to you guys, yes, it's important for going concern purposes. We want to see, can this business actually be sustainable in the future? We want to assess the liquidity, the solvency of this business. Are they taking advantage of new activities, investing activities? Are they still continuing to invest in the business, which is a very healthy sign? We want to pick up all those things from your cash flow statement. Your cash flow statement splits up into three parts. Okay, so your first part from your cash flow statement, you'll have your operating activities, which I'm going to underline here. Under your operating activities, these are your normal operations of the business. So what has happened in terms of your products and your services? Have you received any revenue? Have you made any payments to your suppliers, to your employees? Anything that has to do with the operations of the business, this cash flows and inflows and outflows need to be reflected under operating activities. The second aspect is your investing activities. Okay, under your investing activities, this will include your long-term assets. So not your current assets. So in your current assets, remember, you've got accounts receivable, you've got inventory, and you've got all these different current assets. That is excluded. That needs to be part of the operations of the business. But in your investing activities, we're looking at long-term assets. So if we bought any property, plant, and equipment, if we bought any land, if we bought any vehicles, delivery vans that are going to sit there for a long period of time, have we purchased any during that year, or have we sold off any during that year? That will be reflected under investing activities. Last but not least is your financing activities. So under your financing activities, these relate to your liabilities and your equity. Remember, with the accounting equation, we said assets in the first session need to equal your liabilities and your equity, so that your resources, which make up your investing activities, are now funded from somewhere. Where did you fund all these transactions for? Did you fund them using a long-term debt facility, or did you fund them from an issue of shares from your your shareholders? If you are issuing any shares to your shareholders and your shareholders are pumping more money into the business, this will be reflected as a cash inflow in financing activities. If you are also paying any dividends to shareholders, this will be reflected as an outflow of financing activities. You are giving back to the shareholders. Also, long-term debt, if you pay any debt facilities back because you are making that payment, it's a cash outflow in your business. A cash payments of any debt facilities will be reflected as a cash outflow in your financing activities. Okay, so your cash statement is very self-explanatory. Okay, we've got our operating activities, just the normal operations, revenue, goods and services, suppliers. We've then got our investing activities, our long-term assets. Have we invested in the business, or are we selling off some of our old assets? And then we've got the financing activities. This is your forms of funding. Okay, either your liabilities, which is your long-term debt, or you've got your shareholders, your dealings with your shareholders. Okay, just to go through example, we did an example limited for sessions 1, where we actually put together an income statement and a balance sheet. What I now want to actually go through is a preferred method for looking at the operating activities. The preferred method for looking at the operating activities is looking at what we call the indirect method. The indirect method actually starts off at a starting point in your income statement, where you take the profit before interest and income taxes, and then we want to add back all the non-cash items and all the accruals that you've made happen during that year. Okay, remember I said in your investing activities you do with all your long-term assets. So now in the operating activities, we want to also reflect any movements that have happened in the receivables. Reason being is, if your receivables from year to year, your accounts receivable, people that owe you money, have increased, it means you didn't actually make as much revenue as you thought you made in the income statement. So actually doing all that movement in your receivables and movement in your inventory actually reverses out all these accruals that we created in the income statement and the balance sheet. Okay, so the first step in your indirect method is to first add back all the non-cash items. Your non-cash items will be depreciation, will be amortization, any bad debts, anything that is called an impairment, anything that's created for accounting purposes that does not actually result in cash. This needs to be added back in this item here. Not only do you need to then add those back, you then need to also reflect the changes in your working capital. Okay, if your receivables have increased, people that owe me money, my accounts receivables, I need to receive money from them, have increased, it means I have funded the receivables. I've given them more credit. Okay, if I've given them more credit, I've allowed them to take out assets in my business, it's actually going to reflect an outflow. Okay, if your accounts receivable has decreased, it means more people have paid you back money. If your accounts receivable have decreased and people have paid you money, that's a good sign. You actually have people that are paying you more cash in your business, which means it's an inflow in your business. Okay, let's just drop that. It's a positive. Okay, that's an inflow. Okay, Accounts receivable works exactly the same way as your inventory balance. If your inventory balance has increased or decreased, if your inventory balance has increased, we have used money in our business to cause that increase. We've actually created an outflow. And if it's decreased, we've also created an outflow. The one that's opposite to these two, is actually your accounts payable. So let's quickly write down the accounts payable. If your accounts payable has increased, your suppliers have funded you. They've put money in your business. Because you owe them money, that's actually an inflow in your business. And if your accounts payable has decreased, I have used up money to decrease my balance. I've actually paid off some of my suppliers off. So that will actually result in an outflow. Okay. Let's quickly go through the example limited and the question that we did earlier in sessions 1, just to show you how this actually works out. So in session 1, we had our income statement. Our profit before tax was 3780. Okay, we didn't have a profit before interest and tax. So I'm going to directly take this 3780 and put it there as my profit before interest and tax. Okay, we had depreciation of 0 in this instance. So I actually don't need to reflect a depreciation balance. Let's deal with the working capital, which is a lot of the times the most trickiest part here. Your working capital, you're going to need to look at your movement, okay, of your working capital. My accounts receivable is now sitting at 4465. At the beginning of the year, it was sitting at 0. It moved by 4465. It's increased by 4465. I have funded some of these customers, my accounts receivable. So my accounts receivable has increased by 4465. Okay. If I go down to my inventory initially set at 0, and now the closing balance is sitting at 500. From 0 to 500, it's increased my balance by 500. I must have spent money creating that inventory balance. So my inventory has increased. It increased by 500. Okay, if my accounts receivable and my inventory balance have increased, I have funded that business. So these need to be reflected as outflows. Okay, the last one is your accounts payable. But before you look at accounts payable, if you look here, you'll notice under current assets section here, I want to cover all my current assets besides this cash balance. I've done my accounts receivable and my inventory here. I've done those two, but I haven't shown my prepaid expense. Remember, you only reflected in your income statement the 50 balance here, but you actually made a payment of 300, not of 50. Okay? And if you've pulled this 3780 here, which only reflects the 50, you need to pull in the additional 250 of prepaid expense. Okay? So in this instance, we're going to have a prepaid expense here that we've made an additional prepaid expense. We paid an additional 250 towards electricity. I need to reflect that prepaid expense also there. Okay, now I've dealt with all my current assets within my operating activities. Okay, if I look at my current liabilities, I've got two current liabilities. Okay, I've got the accounts payable and the telephone payable. These have increased both by 1250 for the accounts payable, and the telephone payable has increased by 100. I've used up 100, but okay, they have funded your business. Whenever your accounts payable has increased, they have funded your business. So accounts payable having increased is a benefit for me. I will then show it as negative, as a positive, 1250. And my telephone payable, they've also funded my business by that 100. Okay, I've dealt with all my current assets and my current liabilities, which means I should be sitting with a total here from operating activity